Welcome back to the Fund Monitors Meet the Manager series. Today I'm joined by Alex Lee, the Director of Investor Relations at Laureola Advisors. Laureola are a specialist investment management firm offering conservative risk mitigated exposure to life settlements. The firm was started in 2012 to take advantage of the opportunities in the life settlements market, which provides attractive non-correlated long-term returns. Since inception, the fund has returned 16.1%, the standard deviation of just 5.6%. Importantly, it's remained very lowly correlated to most traditional asset classes, making it a valuable portfolio inclusion. Alex, thanks for joining me.
Glad to be back.
Alex, bond rates continue to remain low across the world, negative in some countries. Do you think this is forcing people to move up the risk curve? And what do you think some of the potential consequences of these movements are?
The short answer to that is investors are being forced to move up the risk curve, to take a bit more risk. When you think about it, what does stimulus actually means? Stimulus means the government wants you to take a risk that you wouldn't normally do in the circumstances that is given. They want you to keep the cafe open when there are no customers, right? They want you to keep your business, keep your employees on payroll when there are no customers. Normally you close the business, but they want you to take a risk that the economy will come back, right? So risk-taking behavior is being rewarded by all of the stimulus actions. Yeah, there's some fluctuations with interest rates up and down recently, but overall, the overall theme around the world is still a lot of strong stimulus. The government wants its people, the government wants the people of the world to take more risk. And the consequence of that is that anybody who is still invested in traditional safe assets like time deposits or bonds are being punished. You're not being rewarded for not taking risks. You'll only be rewarded for taking risks. This is now an extreme situation, right? Let's take an example, like in corporate junk bonds in the US, the ones that are below investment grades, they are paying less than 5% interest right now. And the default rate is actually higher. 1 in 10 of these issuers would default, according to S&P, compared to the traditional 1 in 25 would default. So you are not really compensated for taking risk in a traditional safe asset. Investors have to take more risk. That's by design, by the stimulus, right? And the consequence of that, for the practical consequence of that for investors, is that investors now would have to learn how to take risk, would have to learn how to evaluate risk, and then take the risk that is suitable for their profile and their constitution. And I think this is an interesting exercise for all investors to go through. For example, an investor might be very happy investing in bank stocks, as an example. Now let's dig a bit deeper. What is it about banks that you like? Maybe you like the fact that banks are lending to small corporates and powering the economy that way, so you can exposure that way. So then maybe what you then do is, instead of investing in a bank stock or a bank bond, you would then go, okay, can I go find a fund that invests in SME financing? You kind of lift yourself up into the role of a bank. I've talked about this in our last interview, and that's a thinking that this stimulus action by all the governments is forcing investors to do.
There's a lot of talk about bubbles, whether it be housing, Bitcoin, GameStop, and markets are a bit of a crossroads, not knowing whether to prepare for inflation or deflation. How does life settlements as an asset class fit into each of these unfolding scenarios?
Yeah, the short answer to that is life settlements is completely uncorrelated to those asset classes, to all of those scenarios that's being unfolding. But let's unpack that answer a little bit. What this really means is, if you look at it from a point of view from a portfolio, in a portfolio, there's usually two types of assets generally. There's the risky assets, things that generate a lot of returns, but have probabilities of success, high probabilities of success, or probabilities of success and failure. It's volatile. On the other hand, you have safe assets. So you could have like deposits, time deposits, or bonds. And they play different roles, right? So the idea here is your safe asset anchors your portfolio, keeps some of your capital safe while you take risk on your risky asset. Life settlement sits in this camp. It looks more like a safe asset than it does a risky asset. right? And I'll go beyond just calling it a safe asset. I call it I almost call it a bedrock asset, because it really sits like a bedrock in your portfolio. It generates consistent, stable returns, something that deposits can't do in this low interest rate environment. It's uncorrelated to the risky assets that you want to take risk in. So whatever happens in GameStop, whatever happens in Bitcoin has no impact on live settlements. Live settlements has its own little ecosystem, if you like. It generates returns by investing in insurance policies. So it's uncorrelated to the risky asset. When the risky assets suffer a drawdown, live settlements continue to perform as normal. There's no correlation. So with this as a bedrock, it anchors your portfolio, and that then allows an investor to take risk on the risky asset. So when you come back, if you take this portfolio perspective and how live settlements fits in that portfolio, when it comes back to our current crossroads, markets can continue to go up, markets could collapse from here, right? If it is a market top, it's a blow off, and all of the risky assets come off, live settlements would still be there. It's still playing its bedrock function. It's still generating about 7 to 11% in Aussie dollar terms. It anchors the portfolio. You're still getting a return. Your capital is preserved, right? You might lose capital here. On the other flip side, if risky assets continue to rally, and you have like 5 times, 10 times returns, well, at least you have the exposure. You were able to take that risk because you had that anchor. So this is one of the approaches that answers the first question as well, which is, how do you approach this? And this is the one way of doing it. Think of it from a portfolio perspective. Find the anchor, find that bedrock investment, and then you can take risk, and it might work out really well.
Alex, how have life settlements performed over the past couple of months, and what's your outlook for 2021 for the asset class?
Our fund has returned about 1.3% over the last 3 months. That's in US dollars terms. In Aussie dollar terms, we have a hedge Aussie dollar class. It's about 0.9%. Now it's kind of flattish, right? And that's the nature of live settlements. Our returns from month to month could be quite lumpy. Some months we would do really well, maybe a 2 or 3% return. Some months we will be trading water. It will be flat. And that's a reflection of the asset class itself. One of the uncertainties that an investor in live settlements will have to take is you just do not know when the policies are going to mature. There might be a flurry of maturities in one particular month, and then the rest of the months could be nothing, right? And so that's why we generate the returns that we do. You have to accept this uncertainty. Now, if you pull back, the live settlements industry actually looks like our results just looks like ducks in the pond. In that ducks are calm on the surface, but they're busy paddling underneath, right? There's a lot of things that's going on in this particular industry, and some of it has to do with the pandemic. Quite a lot has to do with the pandemic, actually. So there's a few things that's happening. One, the pandemic has caused some of our larger competitors who have been a bit aggressive in the way they value their policies and the way they approach the market. They bought things that they shouldn't have bought. So they are facing with redemptions, and they couldn't meet those redemptions. The valuations of the policies are not what they thought it would be. So we are expecting some of these larger funds to leave the market in the coming year. As they leave the market, that demand pressure, that pressure that was driving up prices of policies in the live settlements industry would kind of come down a little bit, and that then allows us as a boutique fund manager to really pick and choose which policies we want. In the equity world, we will be like value investors. We really want to pick and choose which policies we want to invest in. That will enable our strategies to work a little bit better. On the other hand, the pandemic has actually caused a few interesting kind of trends to be observed. One, it has reduced the life expectancy of the average American by a year. But this is yet to come through in the maturities. We are slowly starting to see that. And on the same token, because the people who are insured right now are feeling that maybe they will collect the death benefit, maybe they are closer to the policy maturity, they wouldn't sell they wouldn't sell the policies at this point in time. So the supply is starting to come down a little bit as well. So we have this dynamic where larger funds are leaving life settlements. So there is less of a demand issue. At the same time, the supply is coming back down a little bit because insured people expect to collect on their insurance payout because of the pandemic. Right? That environment is fine for us. It actually makes us work a bit harder. It enforces into our strengths because we're looking for policies to buy like an value investor. So it helps us find those and evaluate those and invest in those.
Alex, as I've said before, I find life settlements a fascinating asset class and one I think a lot of investors and advisors don't understand as well as they should. Thanks for joining me and good luck in 2021.
Thank you. We hope to provide the same type of returns every year.